2 weeks ago, the stock market saw one of its worst days in years. You probably remember it unless you just wiped that out of your memory. The markets, thankfully, have since rebounded strongly. So how should investors be handling the volatility? We want to bring in money and business expert Derek Kinney with us this afternoon. Derek, I needed you to talk me off a ledge a couple of weeks ago with this. What has the market been doing? Why is it swinging back and forth so wildly like this?
Well, the market doesn't like any level of uncertainty, Jason. And keep in mind, we've seen big concerns about inflation, big concerns about a recession. And what happened was 2 weeks ago, those were the primary culprits. There was a lot of international issues going on. But since then, it's sort of like the sequel of a bad movie turned into a good movie. We've now seen low inflation. We see jobs numbers look very, very good. Earnings numbers look good. And there is a high likelihood of avoiding a recession. Goldman Sachs came out today and said there's a 20% less chance of a recession. So we're seeing much brighter news on the economic side right now.
Yeah, it was so bizarre. It was like this big panic and meltdown on one day. And it seems like since then that has just sort of evaporated and some folks on Wall Street are happy once again. We've been hearing about the Fed cutting interest rates. That makes them very happy. A lot of folks expecting that to happen when the Fed meets again in September. I know that you always talk about this, especially in that lead up to a rate cut. What does this mean for investors? Is now a really bad time to be out of the game if you pulled out your money on that day that we had not long ago that was so bad?
Yeah, it could be. And keep in mind, generally when the Fed cuts rates, it's sort of a response to the market, meaning you need to be in the market ideally 3 to 6 months prior to the Fed rate cut to really benefit from the stock market growth. So people right now that may be worried, they might have pulled their money out 2 weeks ago. Maybe you don't put it all in, but you ease it in like you're putting a toe in the water and gradually get back in the market, because if the Fed does cut rates, that's typically a good sign for the economy. Borrowing costs go down, more people buy houses and cars. That typically spurs the market. And while you don't want to miss out, you don't want to miss out on some of the growth that could be there as well.
Derek, we always like to, when we're talking about investing, create this specific bucket where we talk about people who are saving for retirement, who might be close to retirement. I guess that differs if you have a long runway in front of you. You know, let's say you're 30 and you still have a long time to build up. What are you suggesting that people do with their money right now as far as retirement savings?
Well, first of all, if you were to panic, don't take it out of the 401k, meaning inside of the 401k, there's typically a cash option, a short-term bond option, places you can put money and keep it safe while keeping it tax deferred and avoiding any type of an early withdrawal penalty. So what I often would tell clients is gradually use the 401k to move money back into the market. Think about things like, it might be called large cap growth, the S&P 500. Big established companies tend to do well in environments like this. Now keep in mind, the election doesn't tend to have a huge impact. Typically, the party that's in power wants the market to go higher, so people vote for them. And then the party that is not in power wants the market not to do well. And so it's sort of this tug of war. But bottom line is most economists feel like things may get better. So being in the market now may be a good opportunity for most people.
Derek, as somebody who has often learned the hard way, I always like to know this. What are the biggest mistakes that investors should avoid when the stock market is volatile like this? It helps to know what those big mistakes are.
Yeah, I would say probably the number one huge mistake people make is they bet too much. They try to make up for lost time. Let's say someone watching right now may be deeply in debt. They've just covered their kids' college. Their house is not paid off anytime soon. They feel like they're behind the 8 ball. They've got to do something bold and brash and almost take that Choctaw casino approach. The bottom line is don't, because the risk is so high. You'd better be able to take smaller risks, and even if you lose some money, at least you don't lose the whole thing. Betting it all on one number, giving the wheel a spin, has cost many people the retirement they've always dreamed of. We don't want that to happen to our viewers.
Yeah, don't gamble. Derek Kinney, whose latest creation, by the way, is called anyonecanbecomeamillionaire.com, which we still need to talk about one of these days. Derek, thank you so much for the timely info, considering what the markets have been doing lately.
My pleasure, Jason. Thank you.